Hey folks, it's we. We need to talk about what will happen to the market in the event of war in Ukraine and what can happen to our money. Tensions are high and a major war in which many countries would participate is not ruled out. Market prices have already fallen as a result of uncertainty, but things could get worse quickly. The United States and Russia never go to war directly. The reason is that both countries have nuclear weapons, and in the event of a direct conflict, the risk of them using those weapons increases. A war in which weapons of mass destruction are used has no winner. That is why those two countries are at war on the territories of other countries, indirectly. This time the country that is a victim of these two forces that are fighting for supremacy in the world is Ukraine. The reason why this conflict in Ukraine provoked the president of Russia, Vladimir Putin, to threaten the use of nuclear weapons is that the United States, together with the NATO, came to the Russian border. The real tragedy, which should be talked about, is the fate of the Ukrainian people. But this is a financial channel, so we will talk about the economic consequences. What can we expect to happen to the markets, and how can we protect our money and maybe make some? History is not a good indicator of the future because circumstances change. But there is one thing that is always the same: people. People trade in accordance with fear and greed, and that is why we will look at this chart: how people trade in case of war. History shows that when a war starts, some things happen again and again. For example, due to changed conditions, supply disruptions occur. Trade between nations is reduced or completely stopped, which means that supply cannot meet demand, which leads to inflation. Second, since countries in times of war need extra money to supply the armed forces, they either print money or issue bonds or both. This also causes inflation. World War I. Since July 28, 1914, when the Austro-Hungarian Empire declared war on Serbia, investors have panicked so much that all liquidity has dried up. The market collapsed, and the New York Stock Exchange was closed from July 1914 to January 1915. After the opening of the exchange in 1915, the market recovered a little, but prices fell again until the end of the war. After the end of the war, as you can see, there was a slight relaxation of the market, but already in October 1919, a great consequence of the war began, known as the Depression of 1920 to 1921. This recession was characterized by extreme deflation, unemployment rose sharply, and the factors that caused or contributed to the decline included troops returning from the war, which led to an increase in labor force, and higher unemployment and wage stagnation. So, the problem here is not only the destruction of economies during a war, but the consequences that come when the war is over. Oh boy. Compared to the Great Depression of 1921, everything else looked like, by the dip. Okay, World War II began on September 1st, 1939, and here we see a decline that lasted until 1942. But we see that in 1942, when the war was strongest, the market actually began to recover. Another proof that it is wisest to buy when others are most afraid. The increase in market prices lasted until 1946, when the post-war bear market began. Just as in the case of the First War, things tend to get worse after every war. The bear market lasted until 1949. This happened mainly due to the poor economic policy in the transition period between the economy during the war and the economy in peacetime. Judging by what history shows us, it would be naive to expect that the next large-scale war can bring something better. So, let's see what can happen with bonds, gold, cryptocurrencies and stocks in case the United States and Russia do not come to their senses. Keep in mind that every war is different throughout history, primarily due to technological advances, and unlike 50 or 100 years ago, today great damage can be done to the enemy without a single bullet being fired with the help of hacker attacks, and that can have an impact on the market also. All we will talk about is something that is known in economic analysis, but that does not mean that new, hitherto unseen things cannot appear. So take what we are going to talk about with a grain of salt and do not accept it as a financial advice. Bonds. Is it wise to buy them? No. Bond returns has been negatively correlated with inflation. Because inflation is already high and it will be higher in case of the war, bonds are not a place when you should keep your money. What about gold? As you can see, the price of gold jumped in 2020. Although it fell slightly after that, it is holding quite high compared to the previous 20 years. One would think that gold is a safe investment in inflation and war, but at such a high price, that should not be taken for granted. Why gold is such a good and such a bad investment at the same time? Gold can be a good investment in time of inflation and war, when you have a lot of money you don't need. In that case, even if you bought gold at top, it is not an irreparable mistake. However, when you have some money that you will need in the near future, gold can get you in trouble. As you can see, the price of gold fluctuates over long cycles. For example, people who bought gold in 2011-2012 lost money and had to wait 8-9 years to break even. This is a gold chart from 1915. As you can see, the price of gold was the highest in 1980, in the last 107 years. The current price is very close to that peak. Think about it when you think about buying gold. Oh, then Bitcoin will jump, right? First, because it is digital gold, and the second, the price is not at the top. Well, the problem with Bitcoin and consequently with other cryptocurrencies is that 87% of the money in Bitcoin belongs to institutions. Here we see that the United States ranks first in the world in terms of Bitcoin trading, and most of that money comes from institutions. Since institutions do not see Bitcoin as a protection against inflation, but as a way to take as much money as possible from retail investors, they see Bitcoin as a risky investment. This means that they withdraw money from cryptocurrencies at the first sign of problems, together with the money they withdraw from stocks that have an increased risk in the event of war. So put it simply, since institutions entered Bitcoin and other cryptocurrencies, Bitcoin is no longer what it used to be. However, considering that people see Bitcoin as a place where they would put their money if there is high inflation in the world, the disrupted transfer of money due to sanctions, it is not excluded that something unexpected will happen. That is, the crypto will go up. Therefore, the crypto market should be carefully monitored. Okay. What about oil and natural gas? Given that Russia is a major supplier, prices are expected to rise. Russia is a major supplier of grain, so an increase in price is expected here as well. The same goes for palladium, whose key producer is Russia. But the potential jump in prices will depend on the type of sanctions the United States and the European Union impose on Russia. Besides that, this potential growth, which would be in addition to the already high inflation of 7.5%, will force the Federal Reserve and other central banks to increase interest rates more aggressively, which will probably have a negative impact on the market. So, the prices of goods whose big supplier is Russia will jump, but how much that jump will depend on the economic measures that will be introduced by the United States and the European Union. We will talk about this more if we have to, so subscribe and turn that notifications on, because this is emergency.